my name is Dana Golden, and welcome back to Introduction to Commodity Markets. And today we're going to finish up our lecture with a look at commodity market demand. Commodities are hard to substitute. It's very difficult to go from one source to another. Lithium, cobalt, copper are very special goods, and they have very special purposes. I like oranges. I like to drink orange juice. But it's not impossible. If bananas cost too much, you eventually decide to eat an apple. Micro fluctuations also drive demand changes. So you have three frequencies of demand. You have cyclical demand, you have structural demand, you have secular demand. Cyclical demand is driven by the short-term real business cycle. Commodities tend to be pro-cyclical. You need more metals for construction when you have a growing economy. This was particularly the case in terms of the China shock in the early 2000s, where we saw a big rise in all the commodity prices, and then in 2008 we saw a massive decline. You have structural demand, where there are medium-term changes in consumer tastes and business investments and efficiency. And then we have secular demand, where long-term factors such as societal level, economic development, and technical change affect the demand for commodities. So cyclical demand is like 2008 recession, changing the demand for the commodity, or the China shock. Structural demand is you have investments in efficiency that bring down the price of commodities. And then you have secular demand, which is what we're going through now with the renewable energy transition. Renewable energy transition is not the first energy transition, but it's one of the next energy transitions where you have a change in secular demand and moving from one commodity to another. An economy was powered by coal, then it was powered by oil and natural gas. Now it's going to be powered by the sun and the wind. So we're only really going to talk about one main demand model in this class, and it's the Nerlove partial adjustment model. So it was developed by Mark Nerlove in 1958 to explain lags in supply and demand adjustments. So there's a supply version of this model, but we're only going to talk about the demand version. And economic agents don't adjust instantaneously to shocks. Demand changes gradually. In commodity markets, there's a really sticky behavior. It's hard to shift away from a particular commodity. So model setup, you have a desired demand at Q and at time t Q star, and then you have some factors that go into creating this desired demand. The major one is the price, but also income and other explanatory variables. And then the adjustment mechanism, the demand today minus the demand yesterday, is equal to the speed of adjustment, this coefficient for how fast you adjust, times the desired demand minus the demand yesterday. This helps explain why it was so hard to get off oil after the price shocks in the 1970s, because there's a lot of stickiness in commodity demand where it's hard to move away from certain particular commodities. So deriving the final model, you substitute the desired demand into the partial adjustment mechanism. So you have this right here, and then you substitute your equation, your regression equation, in for Q star, and then you have alpha plus beta PT plus gamma IT, and then you have QT equals 1 minus delta QT minus 1 plus delta alpha plus beta PT, and then obviously you have an error here. And so this helps explain and forecast commodity demand by saying we know people are shifting away or shifting towards a particular commodity, but they're doing it very slowly, and all these factors change how quickly you can adjust. And then one of the interesting things is that if prices increase, the because this coefficient beta is usually negative, prices increase, the adjustment rate will also increase. You'll move away from the commodity faster. So income also is in here. This gamma is usually positive, and that means that as countries go richer, they don't have as much sensitivity to price, and normally less sensitive to other factors in terms of the quantity. So yeah, you can estimate this model and you can use it as a reasonably good model of how demand slowly changes as a result of changes in conditions. So you interpret the coefficients. Interpret the coefficients. These are all things you estimate. Speed of adjustment, you can use this as a parameter. You can estimate it. Higher delta means faster adjustment demand. Alpha, beta, and gamma are longer effects in demand. And then long-run elasticities can be derived as delta beta over 1 minus delta equals beta. So this is, think about this as like an infinite geometric series. You're changing a little bit each time. You never change the full amount, but eventually you change the full amount, which is beta. It's just an infinite geometric series. Short-run elasticities capture the immediate response to changes, and in the long run, you have more elasticity. So an example of commodity demand analysis, QT, we have these parameters, QT equals 0.3, QT minus 1 plus 0.7 times, and we have alpha is estimated at 2, the coefficient on price estimate at 1.5, and the coefficient on income estimate at negative 0.8, and then we have 0.7 as epsilon, and so we can solve for an equation of the price tomorrow as a function of the price today. Not the price today, the quantity of tomorrow is a function of the quantity of the day, the price, and the income. I was looking at the p variable, which is why I said price. And then this helps you figure out how much adjustment occurs in one period, and then what is the effect of a price on how much will adjust, and the long-run price elasticity. If prices move and it's not going to change back, how is that going to affect long-run demand? This is a very good model of things like OPEC and recent shifts away from more expensive energy sources like coal in the age of combined cycle natural gas. So energy demand and GDP per capita. Here we have countries plotted. We have GDP per capita on the x-axis. We have energy use in tons equivalent of GDP per capita. By the way, always do that. This is a thing a lot of us PhD students learn from our statements, learn by our example, and don't forget to mention the axis in a graph. Even if you're nervous, always in the presentation, practice, practice, practice. Mention the axis in the graph. Here it's GDP per capita, energy use in tons of oil equivalent per capita. As you can see, as GDP per capita increases, this is in 2011, you see almost a linear relationship with energy use. And the relationship goes both ways. People are richer, use more energy. People who have more energy become richer. United States is a major energy user, but is coming down. Energy is a huge supplier of wealth, and never underestimate the relationship between demand and income. Richer people tend to want more things. Commodity market equilibrium. The market equilibrium occurs when quantity supplied equals the quantity demanded at a given price. It reflects the balance between producers' willingness to supply and consumers' willingness to purchase. So you have the supply curve, which is upward sloping, and meets the demand curve, which is downward sloping. And there are some factors that influence each. Importantly, because it's an environmental economics and resource economics class, resource availability is a huge deal here. And lastly, we're going to talk about something we'll talk about next time as well, which is commodity supercycles. In commodities, we have this thing that's very puzzling in a lot of economic models, which is long-run cycles. Some people don't believe they exist. These people are wrong. They definitely exist. So there's the idea of the commodity supercycles. Long-run supply is highly elastic, but short-term supply is highly inelastic. So there's a long lag between commodity price signals and changes in supply. So the idea of the commodity supercycle is high demand leads to high prices, leads to high supply, leads to low prices, leads to low investment, leads to low supply, leads to high prices, leads to high investment. So the commodity supercycle is the investment supercycle where you see macroeconomic investment that drives expansion of capacity, which lowers prices, which leads to lower investment, which leads to lower supply, which leads to higher prices. And this is a long super cycle because there's such a huge investment portion of commodity markets. What's the cure for high prices? High prices. That's an old joke we tell in economics. I think I told that to an economist the other day, and they just looked at me funny. It'd be really sad for me if the new generation didn't know that joke. So what's the cure for high prices? High prices. Yeah, high prices will bring down high prices because of more investment. And then here's a visualization of the supercycle. It's a pretty good model of what's going on. You have, over the course of decades, you have long cycles where prices go up and prices go down. Looks a lot like the stock market, and you might say, what's noticeable about this to commodities? But the truth is, this is very specific to commodities because most goods don't have these years-long cycles that are unrelated to what's going on elsewhere. Most goods are, like the price of shirts, you probably don't notice a years-long investment-driven cycle. And you can see how the events of the world affect commodity prices. Commodity prices rose dramatically with the Napoleonic Wars, fell with the Great Depression. Rose dramatically with the U.S. Civil War. U.S. Civil War, remember, there was an embargo on the South, so you couldn't get cotton in, or you couldn't get cotton out, and you couldn't get goods from Great Britain in. This led to a rise in commodity prices. There were other things going on in Europe at that time that were also kind of problematic. And then you had a long period of peace. And then you had the Long Depression, which was a macroeconomic crisis in 1878. And then you had a real growth in commodity prices. This was a period of immense globalization. Then you had World War I when they peaked, because wars make it very hard to get to commodities. And then you had a fall in the end of the Great Depression when commodity prices just fell out of the market. The bottom fell out. And then you had movement through the World War, and then you moved through lower commodity periods after. Then you had the Cold War peak around 1980, following the rise in oil prices, and then you had the China shock in the run-up to 2008, and then now we're in a relatively strong commodity supercycle, which I am very happy about. And that's, of course, driven by the renewable investment, but it's driven by a lot of things. That's a very exciting time to get in this industry. Get in on the ground floor, become junior analysts, make me proud. Have a great day, and I'll leave you there. See you next time. Thank you.